August was a bad month for stocks. The S&P finished down 1.5%. The tech-heavy NASDAQ 1.74%, and the Dow Jones 3.5%. Mo.
Wow.
It was down. So all three major indices were down in August.
Wow.
No Fed decision on rates, obviously, in August. All they did was they met in Jackson Hole, and they talked about some things. And of course, Powell stressed his, hey, we're not afraid to continue raising rates. Guys, if you like talking about these investment things, one thing, follow me on the Twitter machine. I'm very active there. I talk every day. I have a lot of tweets. I've only had this account for 16 months. I already have 1,800 tweets. I like to engage in useful conversation about the economy and the stock market. Now, Mo and I don't care to look at the short-term, month-to-month swings in the market. Any given month, there's about a 50% chance. I don't know what the exact number is, but there's about a 50% chance the market's up versus down, okay? That's awesome. But we're trying to teach a long-term viewpoint of the markets. And what the market did in August should have no effect on what your net worth and what your growth is going to be over the next 20, 30, 40, 50 years. We have people who watch this channel who are as young as 15. We have people who are in their 70s who watch this channel. Obviously, where you are, if you're closer to 70, this does matter a lot more for you, where the market did last month. But if you're 15, 20, 25, 30, 35, it doesn't matter. What matters is, are you saving money every month? Are you putting them in low-cost ETFs? And if you're a buyer of individual stocks, do you have a process that over long periods of time will do well in the market? Now, obviously, this year has been a huge year for stocks, especially the Magnificent Seven. These huge stocks, NVIDIA going from 100 to 500. Tesla is even up big this year. Guys, remember, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. What does that mean? It means that whatever's popular in the short run is going to go up. Whatever's not popular is going to go down. But in the long run, what matters is if you pay a reasonable price for a business, the fundamentals will drive your returns. So what happened in Jackson Hole? Mo, I know you found some things here. Tell us what happened.
So this is from the Kansas City Fed, and they're basically dealing with the inflation aspect, which is a huge aspect that is touching everybody. So I like that Powell really said, we're going to stay the course.
Yeah.
And they even referenced in here from the 1970s, 1980s, the lessons that they learned. Don't ease off too early.
Yeah,
that's what you have, that double dip recession. You ease up on rates, inflation spikes back up, and you're like, oh, damn, we got to raise these things fast. They're not going to take their foot off the gas.
Correct. And Paul Volcker was the Fed chair back in the early 80s. Mm-hmm. And what he decided was, listen, remember, he didn't have social media. He didn't have day-to-day news to respond to. He said, this is going to get ugly, but I'm going to fight inflation by jacking up rates. And if you saw, I just posted today on Twitter, back then, I mean, the 30-year mortgage rate was like 14, 15%, because rates had to skyrocket so much in order to fight inflation.
Right.
Now, Fed Chairman Powell has every Twitter account out there, every news organization out there, hanging on every single word he makes.
Yeah, and he even said, we need to make sure our communication is extremely clear.
Oh, yeah, but you know what? He's saying clear in the sense of...
Yeah, clear in the sense of he's going to tell you, well, the problem is with clear, everybody interprets it differently.
Of course.
So,
and I interpret it as, this is our mandate. This is what we're going to do. We want 2% core inflation, which remember, guys, 2% core inflation means excluding food and energy. Because when I first heard 2% goal, I was like, wait a second, but historically we're at 3.5%, and we've printed a ton more money. Then I realized it excluded food and energy, right? Now, I want everybody to also consider the fact that in the short run, when we're talking about business fundamentals, the economy looks good. But it's interesting, when we had 0% interest, the market's actually higher than it was when we had 0% interest rates. And everybody thought that raising rates would cause the market to fall. And it did last year. But now we're above those levels. And now it's good economic news is a bad thing for the markets. Yeah. Bad economic news is a good thing. Yeah. Why? Because with bad economic news, people believe the Fed will drop rates faster, or they'll get to dropping rates.
Right. It's almost like that in October of 2022 when rates were zero.
No, that was in October.
What? Remember the lows of October?
Yeah, the lows of October rates were still.
What were the rates?
I don't know, 3.5%, 4%. I'm guessing off the top of my head.
So the fears were that they go higher. They basically
almost
double, and they did, and the market well surpassed those lows and even is going towards highs. And so it doesn't make any sense. It's almost like during COVID when we had that big pullback in March of 2020. people were saying, oh my gosh, they're going to shut down the country. Businesses are not going to have revenue. And then that happened. Market went like this to all-time highs.
And but there are other factors in both those environments.
Yeah.
That's what I say to people, like,
Not just one thing.
and it's also, it's hard to guess these things. All we're sitting here doing is we want to teach this process of looking at the market overall and say, where does it stand in terms of valuation? Now, as you know, in our community, I announce this every day. Let me show you guys this in our community. So in our community, we have the Pulse Stock Market Indicator. And every single day, every single market day, I announce the stock market GDP ratio and the 10-year cyclically adjusted PE ratio. Now, this is what these do. The stock market GDP ratio is the ratio in which you take the entire stock market cap and compare it to GDP. Warren Buffett considers this to be the most reliable metric at any given time on where valuations stand. Now, of course, there are the naysayers out there that sit there and say, oh no, that's BS, blah, 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 because of X, Y, and Z. Fine. But then the 10-year cyclically adjusted PE ratio takes the last 10 years of profit in the S&P, brings it to today's value with inflation, and says, where do we stand? Guys, we are 80.6% overvalued on the stock market to GDP ratio going back to 1929, and we're 82% overvalued on the 10-year PE going back to 1929. That gives fair value in the S&P around 2,500. Now remember, these metrics 5 years ago said fair value was 1,600 or 1,700. So over time, the markets can continue to go up, and as earnings go up and as GDP increases, it's going to drive up these values. But to be at 80% overvalued in history, whenever this happens, the next 10 years are ugly, flat or down. That's the hard part. That's what we're just sitting here saying, listen, there are still values to be found out there. In the next 10 years, there'll be companies that grow tremendously. But overall for the market, you probably won't experience the same gains we got in the last 10 years. Because look at where we were 10 years ago. Let me actually pull it up. So going back over the last 10 years, 10 years ago, which would have been like June of 2023 in terms of the ending date, 2013, I mean, the stock market was essentially even, right? So the previous year was about even. And look at the returns, 9.3% over the next 10 years, not including dividends. Okay, that's good. Now we're expecting negative returns because anytime we're over 50% over, we have negative returns. And the 37 times that occurred, the average return was negative. That's pretty bad. Now go back to 2000. Go back to 2000 when stocks weren't even as overpriced as they are today, and look at the next 10-year returns. All negative for a chunk of time. This market has been overpriced for a long time. It has made me feel like, okay, I'm wrong. Like, obviously, people are like, Paul, you've been negative in the market for 5 or 8 years. Absolutely true. Absolutely true. And the biggest mistake I made was not realizing how big this market boom could go. Absolutely. And I take full ownership of that. And I've learned my lessons from that. And I'm lucky that I'm only 42 years old and have 60 more years of investing in order to recoup those misses. Did I still buy some stock? Absolutely. I have 12 stocks right now. Am I building positions in them? Absolutely. I learned about options through our community. I learned about trading through our community. But that's what I do here. I just want to sit here and say to people, guys, this is where it stands. In every single quarter that we modify our GDP higher, these go less and less overvalued, and as if stocks stay the same or go lower, and our fair value increases. But it's just as a reference point. This doesn't mean go sell. It just means, hey, just be ready for worse returns over the next 5 to 10 years. That's fine. Because your job is to invest in low-cost ETFs.
And have some dry powder ready when markets do fall, if that's something you do with a little bit of your portfolio.
Absolutely. Now let's see where we were at the beginning of August. End of July, we were 85.6% overvalued on the GDP and 87.7% overvalued. And of course, stocks went down, as I told you, and that's why valuations are better. And on top of that, the June GDP numbers got modified as well. Guys, we're just trying to teach a process here. That's all we're trying to do. If you like the idea of being able to have a process that you can understand and enjoy, subscribe to the channel because it'll make sleeping at night much easier. When you understand things, you fear less. The more you learn, the less you fear. And that's all we're trying to do here. And that's why people in this community love when I post these things. It's a way of us engaging together to talk about how we feel about investing, because emotions of investing are the most important part of successful investing. Thank you very much for your time.